Hi, welcome to the Rule Based Trader. Learn and earn with me free options trading for beginners course. In the last videos, part 1 and 2 of options terminologies, we learned about underlying assets, call and put option, and how to read an option chain. In this part, let us learn about option Greeks. Here, for your quick reference, once again I have shown a typical option chain. Basically, you don't need to know what option Greeks are to trade in options. You can go out there and simply start trading in options by buying or selling of call or put options and make or lose money. But understanding of options Greeks is important to take informed decisions about which options to trade and when to trade them. So, what are option Greeks? Simply put, option Greeks are the factors that affect the price of an options contract. These are delta, gamma, vega, theta, and rho. A quick look at what each option Greek means and how it affects the options price with regards to change in the underlying asset. Later, I will explain these Greeks by taking an example. Now, first comes delta. It measures the change in options price per 1 rupee change in the underlying asset price. It typically ranges from -1 to 0 for put options, 0 to 1 for call options. It can also be said as delta predicts the probability of option expiring in the money, which means suppose the delta value is 0.5, it means the option has 50% chances of expiring in the money. The next one is gamma. It measures the rate of change of delta per 1 rupee change in the underlying asset price. It typically ranges from -1 to 0 to +1. It's always positive for long options and it's negative for short options. It can also be said as the gamma measures the stability of the probability of option expiring in the money. The next one is theta. It measures the rate of change of options price with the passage of time. It typically ranges from 0 to -100. It's always negative as the time value always decreases as expiry nears. It can also be said as theta measures the rate of time decay. It accelerates as expiration date nears. The next option Greek is vega. It measures the change in options price per 1% change in volatility. It typically ranges from -1 to 0 to +1. It's always positive for long options and negative for short options. It can also be said as the vega increases in reaction to quick moves in the underlying asset. It falls as the option gets closer to the expiration. Not but not the least, the option Greek is rho. It measures the change in options price per 1% change in interest rate. It typically ranges from -1 to 0 for put options and 0 to 1 for call options. It can also be said as rho is the measure of sensitivity of options prices to change in the interest rates. Before looking at an example, first let us understand that an options price is made up of two components. One is intrinsic value, second one is the time value. When trading in stocks, the actual price of the stock that you trade is its value. But while trading in options, the options price or the last traded price that you see is made up of intrinsic value and time value. Here I have taken in the money call option with some time to expiration. Suppose the stock price is at 120 rupees and you want to buy the call option with a strike of 100 rupees and the option price is 30 rupees, then it is made up of two components. One is the intrinsic value, which is 20 rupees, and the second one is the time value, which is 10 rupees. Suppose at the expiration date, the stock price remains at 120, then your options price will be only 20 rupees. It will only have intrinsic value and there will not be any time value to it. And at the expiration date, suppose the stock price is at 130 rupees, then it will then your options price will be 30 rupees, which is completely intrinsic value. There will not be any time value to it. And suppose at the expiration date, if your stock price goes above 130 rupees, then only you will be profiting, which will be a full intrinsic value of 40 rupees. And there will no any time value to it. Let's quickly see how a typical options contract looks practically and its components. I have taken this screenshot from my live trading videos. You can also watch them under my channel's playlist Daily Update of Live Trading in Nifty and Bank Nifty Options. Here you can see I have just taken a screenshot from my portfolio. An options contract will have underlying asset, either it can be a stock option or an index option. Here in this case it's Bank Nifty, an index option, and it will have an expiration date. Here you can see 17th November. That will be Thursday of every week for index options, and if it's a stock then it will be last Thursday of the month, and if Thursday is holiday then it will be a previous trading day as expiry day. It will have a strike price and it will have an option type. Either it's a call option or a put option. Additionally, here in this screenshot, you can see the quantity. It is shown in negative because I have sold the options. It will be positive if I had bought the option. And you can see the sell price. You can see the profits in green and it will be red if it's in loss. You can see the buy price as 0 because these are still open positions. You can see the last traded price of this options contract as well. So this is basically an Alice Blue mobile application. For other platforms, it may look slightly different as well. Now, I have once again indicated typical option chain here on the left hand side. On the right hand side, you can see, for example, I have taken from my previous slide screenshot itself, an options contract, Bank Nifty 17 November expiry for 2500 strike, call option. Suppose at the money, call option is valued at 500 rupees and delta for at the money call option or put option will always be near to 0.5, which means that if the Bank Nifty moves upwards towards like 42,600 or 42,700, my delta will start moving from zero point 0.5 towards 1, and every change in price of Bank Nifty 1 rupees, there will be equivalent change in the options price with respect to the delta of 0.5, 0.6, 0.7, etc. If the Bank Nifty starts going down like 42,400, 300 and 200, my delta will start moving from zero point 0.5 towards 0. And gamma will be measured with the rate of change of this delta. And regarding theta, if regarding theta, theta will always have intrinsic value as well as the time value, which will be for the out of the money call options as well as in the money call options as well. Suppose at the expiration date, if my Bank Nifty expires at 40,500 itself, and if I had bought 40,600 call option, then all the options value will be eaten up by the theta. There will not be any value to it. And Vega will be explained at the rate of change of percentage volatility in the market. So that should have given you a general idea of options Greeks. In the upcoming video, I want to throw some light on options buying versus selling, which has more probability of winning and under which market conditions. Thank you so much. Please like, subscribe to my channel and share with the like-minded community of traders who wants to trade options. Thanks again.